Hey everyone, I'm here with Do Money, and today we are going to talk about open enrollment for your health insurance plan and how to decide what plan to choose. Stick with me and I'll explain all of it. So, how to pick the right plan? First, you need to consider your network. The network is a group of doctors or medical care providers across multiple specialties that have the contract to provide health care for your specific insurance plan. In-network care is typically cheaper because the insurance company has negotiated a rate. Depending on the plan, you might be able to see an out-of-network provider, but it'll usually come with a higher cost. So, what to consider are the doctors that you're currently seeing in your network. So, what I recommend is make a list of all of the doctors, and then whatever website you're using to enroll, if it's your employer's or if it's Obamacare or ACA, then you want to go ahead and enter those providers into that website and see if they are considered in network. The next thing you want to do is consider your budget and your income. For HMOs or health maintenance organization accounts, it's a popular choice for those that might be budget conscious or if you don't anticipate having too many doctor visits. An HMO usually is a smaller network of providers, and you have to select a primary care or PCP. This PCP will also have to give you a referral if you ever need to see a specialist. That's really important to know. Usually HMOs, because they have a smaller network and you have to pick exactly who you're going to go to, or they tell you who you're going to go to, then it comes with a lower monthly premium, and it's generally lower out-of-pocket costs. It's really important to understand that this normally comes with a higher deductible, and we'll go over what deductible means in just a minute. Usually an HMO is good for low income, or most ACA or Obamacare plans are HMO plans. Next, you have your PPO, which are your preferred provider organization plans. These are a much larger network. You're not required to stay in the network, and most plans will tell you what the cost is for selecting an out-of-network provider. You don't have to select a primary care physician either for this one, a PCP, and you do not need referrals to see a specialist. So if you are someone who has a critical condition, or you anticipate going to the doctor a lot throughout the year, you probably want to consider, or you travel, you probably want to consider something more like a PCP, where you have a wide variety of doctors that you can see without a referral and anywhere. You might also want to consider a PPO if you're looking to have a health savings account to save on taxes and potentially have your employer contribute. Okay, there's some really important vocabulary we have to go over. One is premium. What is premium? So the premium is the amount that you typically pay monthly. The policyholder pays monthly for their health insurance coverage. So that's the base pay that you're always going to pay, normally taken out of your paycheck. Then you have your deductible. The deductible is the amount that you pay for your covered health care services before your insurance plan starts to pay. So for example, if you have a deductible of $2,000, then you pay the first $2,000 before your health insurance will pay the rest. What comes after deductible is called co-insurance. The co-insurance is a percentage of cost of a covered health service that you pay after your deductible has been paid. So normally, let's say it's normally like an 80-20 split. So you pay 20% of the cost while your insurer pays 80% of the cost. So for example, you have a $2,000 deductible and you've already met it. So you have paid $2,000 out of pocket. After those $2,000, let's say you have another $1,000 health related bill. So the insurance is going to pay 80% of that, or $800, and then you're going to get a bill in the mail for $200. That's 20% of that $1,000. So again, that's co-insurance. There's another term that is often tied to health insurance, and that's co-payment. It's very different from co-insurance. The co-payment is a flat fee that you're going to pay when you go to a doctor or when you get a prescription drug. And not every plan has a co-payment, and not every plan's co-payment goes towards your deductible. And that's really important to understand. Okay, so how do you decide what deductible amount to choose? If you're mostly healthy and you don't think that you'll be going to the doctor a lot this next year, then you can potentially pick a plan with a higher deductible and a lower monthly premium, because you're not likely to then eat into that deductible if you're not planning on going to the doctor much. If on the other side, the flip side, you have a medical condition that needs care and you know you're going to be visiting the doctor and potentially many specialists throughout the year, you might want to consider a lower deductible but higher premium. So you'll be paying more out of your paycheck every month, or your base pay is going to be higher, and your deductible, the out-of-pocket expenses after that premium, will be lower. So there's one more big term to talk about, is after your deductible comes your coinsurance. After your coinsurance, you want to consider what your out-of-pocket maximum is going to be for that healthcare plan. Your out-of-pocket maximum is the most in medical expenses that you're going to pay throughout the year. So what you need to consider here is once you reach your annual out-of-pocket maximum, your healthcare provider will pay and cover all the rest of those costs. And we're going to go over an example. So let's say you have a plan with a $3,000 annual deductible and 20% coinsurance with a $6,350 out-of-pocket maximum. You haven't had any medical expenses at all this year, but then you need surgery and a few days in the hospital. The hospital bill is going to be about $150,000. You will pay the first $3,000 of your hospital bill as your deductible, and that's coming out of your pocket. Then your coinsurance kicks in. So your health plan is going to pay 80% of that now $147,000, right? Now we're looking at $147,000. They're going to pay 80% of that, and then you'll be responsible for 20% of these expenses, up to the remaining of your out-of-pocket maximum. So looking at the numbers, you have the 20% of the $147 is $29,400, but you only have $3,350 left of your out-of-pocket maximum until you get to the $6,350. So your deductible goes into your out-of-pocket maximum. It counts towards your out-of-pocket maximum. So what that means is that out of the $29,400 minus the $3,350 that you will have to pay, those other $26,000, your insurance is going to pay for that because you've hit your out-of-pocket maximum at that point. So of course, depending on your plan, your numbers will vary, but as you can see that once you hit your out-of-pocket maximum, that $6,350 is way less than that $150,000 hospital bill. Okay, so how do you decide? You might not know if you're going to have a lot of doctor's visits or not. You might be having a child. You might have a chronic illness that sometimes have a good year, you sometimes have a bad year. So how do you know what it's going to cost? Now you have to crunch the numbers, and this is an easy way to do it. So what you're going to do is you're going to compare two plans at a time. You're going to take your annual contribution, so that's your premium that you pay every single month. And so let's say for a high deductible plan, you're paying $150 out of every paycheck. So high deductible usually means lower premium, right? So $150 out of every paycheck for a total of $4,050. Then you have a deductible of $3,500 that you have to pay. Then you have another $1,500 of your out-of-pocket maximum that you have to meet, right? So you add all of these dollars together, assuming you take it all the way and you use all the way through your out-of-pocket maximum. So the total cost to you is going to be $9,050. But you also have to consider if you have a health savings account, which usually comes with, or it can come with a PPO if you choose. A health savings account, usually employers, if you're employed, will pay towards that health savings account. So how much will they pay? You want to subtract that from your total cost. So in this example, if your employer contributes $550 towards your HSA during the year, then your total cost for insurance would be $8,500. Then on the flip side, if you're looking at a low deductible plan, let's say you pay $200 every paycheck. Low deductible means higher premium, right? And your deductible is $1,500. And then your out-of-pocket maximum that's left over is $3,000. So what you have total cost to you is $9,900. So before that HSA contribution, the high deductible plan is costing you less than the low deductible plan. Okay, these are really important numbers. And then the HSA contribution may or may not flow into a low deductible plan. You want to make sure that you're paying attention to those details when you are enrolling this open enrollment season. I hope this video was helpful and you found it interesting. If you want more information on personal finance and taxes, please like and subscribe, and I'll see you next time.